Hello and welcome to this week's Ferrari Financial US Market News Summary. Well, as we expected, this week was all about consolidation, really. It wasn't going to happen before the Fed's meeting next Tuesday. The investors are just sitting on their hands at the moment to wait to see exactly what the Fed is going to do. After a little bit of a sell-off on Monday following on the jobs report surprise on Friday, the week before, the market did try and recover, and by Wednesday and Thursday had a couple of attempts at pushing the index level up a bit higher, but by the end of the week only managed a small gain over the 5 days. All eyes are firmly focused on the Federal Reserve's announcement next Tuesday, when at least 25 basis points are expected. But a cut of 50 basis points is really what the market is looking for and hoping for. We feel the market may have already priced this in, though. If we take a look at our chart.
We'll take a look at the 6-month chart for the Nasdaq Composite Index now, because I really want to concentrate and focus on the action over the last couple of months, when we reached that peak in the middle of July up here, and then rapidly dropped down to the short-term trend line, a little bounce off of that, and then we had that frightening day when the Nasdaq actually dropped below 2,400 for a brief moment. Since then, of course, we've had a pretty respectable pullback. But if you look at the level that we're at the moment in particular, but certainly the level that we reached a few days ago, the pullback was pretty well in the normal range of about 70%, which is about the maximum we would ever expect for just a pullback, before, of course, the market then turned south again in the last couple of days. The really, the really interesting point here, though, is when we look at the volume chart down here. The daily volume was gaining a little during the peak and the start of the sell-off, but the really interesting feature as far as we're concerned is that the peak volume here over 3 or 4 days, where the volume was very, very high, well over 3 billion. We are seeing that not at the low point, as an indication that the market was getting back in to a buying phase, but in fact at the short-term bounce of the trend line, when it reached this point here, we see the maximum volume days. Now that's significant to us because it meant that people were really still selling off strongly the first opportunity they got, and that immediately drove the market right down to that frightening point of 2,380 briefly, before then the promise to the market really from the Federal Reserve, and then the action of cutting 0.5% off the discount rate really lifted the market spirits and caused this rather nice recovery rally up to the point we had a few days ago. However, this recovery was done on relatively low volume. If you look at the volume levels during this recovery phase, they're quite low, again indicating to us that the likelihood is that the downturn is not over yet. Again, the volume has increased as the market level increased, and we've had this sell-off now on the rather poor employment news on Friday, and next week we're feeling that more selling will occur. The scenario we pointed out a few weeks ago is probably still the strongest scenario at the moment, which is that a channel was formed, which bordered by this top line I'm drawing here, and the low that we reached down at 2,380 briefly. That is a channel that we see the market working between, and certainly there's plenty of room for the market to now drop back down to about the 2,400 level, and we feel that's most probably where the market's going in the next 2 to 3 weeks.
We also feel that this consolidation phase may not be over. Even if the Fed does cut as much as 50 basis points on Tuesday, we feel that the market has already priced this in, and there may be a short relief rally, but we don't think this will really be the start of a massive move to the upside. In fact, we really side with the opinion out there at the moment that's forming that if the Fed does cut 50 basis points, it's really an admission that the US economy is in worse shape than at first thought. And a substantial rate cut from the Fed will, of course, just add to the dollar's woes. At the moment, historically low against both the euro and the British pound. We would like to be able to say to you that if the Fed does cut substantially on Tuesday, we would recommend that the market would then move sharply to the upside and things were looking better. But our position basically hasn't changed. We still feel there are too many factors out there which are likely to cause the market to sell off gradually over the next few months. And if that's the case, and we actually see high levels of selling into the strength, temporary strength caused by a rate cut, then we would recommend that you do the same. Sell long positions during that short period of strength and start taking short positions again to take advantage of a downturn in the next month or so. So that's our read on the situation at the moment. Until next week's summary, it's goodbye from London.